Perfect. So, guys and girls, welcome back to another BMO video. It's Tuesday, the 19th of December. And today's more of a roundtable, more of a discussion, predominantly discussing hedging, but of course we can bring other topics into it. Again, aim of the game here, I don't want to be just leading the session. I don't want to be, me talking, and then bye, have a good evening, and then we go. I'd like it to be sort of as interactive as possible. You can, if you don't want to unmute, you can type it in, put your questions in, just be as interactive as you can. Today, we're going to focus on hedging. Tomorrow, I believe myself and Julian will go into psychology if there isn't any other suggestions, although I would really love some suggestions to be thrown at us. And then, again, from tomorrow's session, then I'd like further suggestions for Thursdays. Before we go into that, the announcement, before we go into the hedging session today, the announcement myself and Mark made yesterday, just to clarify, it affects no dynamics in BMO whatsoever. What is in BMO right now remains. It's, the breakdowns twice a week, the guest speakers, the institutional documents, literally zero, absolutely zero changes. It's just no additional people will be coming into this community from January onwards or January 5th. Then everybody who's coming into the community will be directed elsewhere. So if anything, if I was a member in BMO right now, I'd be looking at it like, well, we're getting more value for money. And not just that, it's going to be very intimate, locked off. Nobody else is going to be joining. There's going to be no, you know what I mean? It's molded from that point. But if you do have any questions on the matter or anything to discuss, really, you know where I am, you know where Mark is. Put it in the Zoom today, the Discord. We're very much open book here, where the transparency is key for us. So yeah, with that being said, hedging. Anybody, I know Julian in here. I believe Katie potentially. I think I've spoken to you about in the past. I know Aya, we've had a chat about it as well. Anybody here has experience with hedging? Let me know or you can unmute, put it in the messages. Anybody here that has experience with hedging, and sort of what's your approach before I go into it? How are you approaching hedging? What's your perception of hedging? Why do you do it? Let's open the floor with regards to the topic hedging before I sort of show my hand on it. Everyone's like, "Ooh, who's going to speak first? Who's going to message him first?" Come on, I want this interactive as possible.
I don't want to be the first one to do it, so like somebody
Yeah, I
else
was
can do it.
thinking that.
Okay, Katie,
Let's
I'm
go.
gonna have to pick on
Okay.
you.
Let's
I'm
go.
sorry.
Okay, if I'm completely honest, I know what hedging is, I know how it works. Do I use it all the time? No. Do I feel confident using it? No, not all the time. But my perception of hedging would be that you're using it in a market where there's no clear divergence. So at the moment, because we are at a peak of an economic cycle for most currencies, it is recommended to hedge your positions because there's news events that could swing the position either way. The way that you would go about hedging would be to use order flow, and mainly you're going to try and use the higher time frame, so daily, 12-hour, 8-hour really, and you're using the previous supply and demand candles to
basically read to almost digest the flow of both sides of the market.
Yeah, and then you're going to use the
Hello, were you still here?
Oh yeah, sorry, my TV just turned on. Yeah, and then you're gonna use their demand and supply candles on the opposite side of your trade to get out, so as a target.
Yeah, no, that's a great start, and I appreciate that. Thank you for throwing that in. I think you're definitely on the right track. I don't want to give anything away too soon yet. I'd rather hear some more opinions before I sort of throw my 50 pence in. Julian, I'm gonna pick on you here.
Okay, so how I look at hedging is super simple. Basically, when there's economic uncertainty, what's the word, Drew?
Divergence or convergence, or when there's an incident.
No, uncertain. I'm not
certain. Sorry, buddy. Uncertainty.
Yeah, uncertain. Yeah, this word. Okay. So when I look at this and we have either news events, or let's say macroeconomic events that could, change the market really quickly if anything happens, I'm looking to hedge. Most of the time I use daily 12 and 8-hour time frames to look at places that I'm looking to hedge. For hedging, I also need to have my my bias already in, so my previous position. So let's say I'm gonna take GA as an example because it was the most recent which I was looking to hedge.
To be fair, GA is the example we're going to be using today.
Oh, okay, yeah, okay, yeah, really simple and beautiful, even for order flow. And I needed to be on my first position before edging. So let's say I'm in the sell. When we look at GA, we could clearly see that GA was moving in a kind of let's say triangular way. If you look past at past teaching, maybe you remember like Kendall's patterns and whatnot. But it's clear that there was some position getting filled in as buy and sells. So you could look for places to, your bias is sells, right? But it's not sure that it's gonna break the low that we're looking at. So what I'm doing by that point is, okay, so at that spot it could be a buy. Market could push it higher, and I still have my sells in. So the cool thing is I took my 2-2-1s on my sells. Then if I enter my buy and it gets broken, I'm break even, right? So I don't lose anything. And if my buy, so my edge goes, I take my 2-2-1. So now I'm 2% up. And whatever the market can goes, I'm edge, and I'm already positive. I think it's delta positive that drew
Yeah,
the real
that's what we're
term.
going over today. Yeah,
So this is
just to throw
yeah.
that in though, Julian is coming in at 1%. For those of you that sat there like, how is he 2% up? So Julian would come in at 1%. He'll split it into a 0.5 and a 0.5. If his short hits a 2-to-1, he's 1% up, and then if he's hedging it long and that hits a 2-to-1, he's of course 2% up.
Okay.
Okay, yeah, thanks, Julian. Anybody else before I take from here? I think Ayub, I think, have you sort of started to dabble within the hedging realm? But I know we've spoken about it briefly. Sorry to pick on you, buddy. I'm just trying to get some voices here. I
No,
know
it's
we've spoken about it.
yeah, no, I haven't actually used it, but I wanted to use it throughout the last couple of months due to obviously the uncertainty going on. And I think one of the obviously questions that I have is, obviously this will be for later on, is where exactly do you hedge? Is it same, would you use the same framework as to how you're entering buys and sells, highlighting where buyers come in, where sellers come in, and then using that where you'd see where this could be a potential area where the position would reverse onto you? But more so, I think from my stance, even though I haven't used it, highlighting both sides of the market has made it a lot easier to figure out, okay, this is where I should hedge if I was going to.
Yeah, no, I think you've actually put a really good point in there that I can build off of and stem from there. So let's sort of open up the floor. And you are right with regards to the issue most people struggle with is identifying A, where to hedge, and B, sort of, is this the right area? Is now the right time? Yeah, protecting capital. Correct, Julian. We should let Jordan in. There we go. So what I'll say is this, to sort of open up the discussion. Hedging is similar to having car insurance. It's similar to having house insurance. You don't plan, you don't plan on your house going up in flames or crashing your car, but likewise, you pay it for certainty. Now, you're paying it to lock in certainty during uncertain times. So hedging, and I think Katie mentioned it, because we don't have a clean divergent market right now. We have more of a convergent market where economies are simultaneously or similarly going into the same sort of next phase in their cycle. So uncertainty is rife, essentially. We don't have that clean cut, for example, post-COVID, Bank of Canada hiking rates, oil prices flying, and Bank of Japan holding rates negative. We don't have that clean risk-on divergence, carry trade favoring CAD yen upside, for example. When you have uncertainty presented to you as a portfolio manager and a trader, you must basically hit that uncertainty head on with a plan. Now, in my humble opinion, I've had, and I mean hour-long conversations and arguments about this. Majority of people, and Julian made a very interesting point earlier about how he has his initial bias and he will hedge from there. I take a rare sort of opinion and stance on this, which is very controversial, but I don't see anything wrong with going delta neutral at times. Now we'll get onto what this means and go on to it and so on and so forth. But this is a sort of place I want to start. It depends on my position, but I'm either what we call delta negative, delta positive, or delta neutral, right? And for those of you that understand sort of, I know Liam and he's done a lot of sort of advanced maths and stuff, and you've got your alpha, your delta, so on, your beta, what, yeah. All it means essentially is this: if I am severely uncertain, I will lock my position in. Meaning, if I'm 0.25% exposed long, I will come in 0.25% short and I will lock that movement in. Meaning the P&L that I'm in right now will not go up or down. It will lock. So the position is delta neutral. Now, when's a good time to use this, for example? Let's say you've long cable out of 122. I didn't come in delta neutrally, by the way. I was actually net long on my cable position. But let's just say hypothetically, you've bought cable out of 122 and it's rallying high. and then you're at the 127 handle, and you are very uncertain of what the BOE are going to say next. You actually think the Fed may even come out and hike and so on and so forth. And you have an absolutely transparent reason to be both long and short at the same time. And you have no clean cut bias. You can see the risk off side of things. You can also see the weaker dollar, risk on, pro-cyclical rally of the pound. You're sat there and you say, this logically makes sense to go either side of the market. And I can see both sides clean as day. Locking in your trade delta neutrally means, say your P&L's in 7-8 grand and you lock it in. You open up the same lots short as you are left long, right? All that happens is you're buying time. All it is bang, you lock your trade and it's like, okay, now whatever the market decides to do, I am okay. I can buy time here because I'm unsure. I need more data. I need more opinions. I need this. I need that. And so on and so forth. So I am just going to lock this in here. I'm going to be neutral for now until I know my next play. Now, as data develops, as price develops, so on and so forth, you may start to average out a bias here and say, do you know what? Actually, I'm net long. And you're looking to then, as you're delta neutral, you're looking to add another position long in, which will, of course, take you delta positive long or net long, however you look at it, right? Now, very rarely I will come in neutrally and say, do you know what? I'm on the fence and both sides of this market make sense to me. But there's a misconception, in my opinion, in this industry that you can never be neutral within your hedge. I think that is absolute BS. The amount of people I've spoken to that have said, if you're hedging, you've always got to have a net bias. I agree, you have to have a overall like a 3, 6, 9 month outlook that you think, do you know what? This is the reason why I'm positioning here, and I can see upside of 3, 4, 500 pips if X, Y, and Z happens. But in the moment right now, if you're uncertain, there's a bias flipping, you may look at it and say, I just need to lock this in and I need to essentially buy myself time. Now, the reason I start with the delta neutral side of things, I can see the comments and questions coming in. I'll get to them now. The reason I start with this is the hardest one to understand. Whereas when your delta is positive, or if you're net long or net short, okay, essentially all you're doing is hedging, but at taking the left side of the opposing side of the market, which I'm going to visually show soon alongside the verbal side of things. But before we do that, I just want to highlight the neutral side of it is very, very hard. That's the hardest one to understand. So it'll make the other topics much, much easier, okay? But this, just so I can see the questions coming in, this, so that all of you know, this is the least likely hedging model you're going to deploy. Very, very rarely are you going to be in a market and say, I don't know if this is going to explode to the upside or the downside here. It's very, very rare, usually peak and troughs of cycle when you have arguments for absolutely both sides of the coin. So your risk is equal on both sides of the market. Yes, if you want to, literally what we're saying here, so you're neutral, you're just locking it in until you get more data, more rhetoric from central banks, more technical development, until you go, right, now I want to be net long. And then you'll just buy at your next point of interest, wait for your sell to get taken out and let that both positions rally up then. When you're saying locking in, do you mean you've closed 2 to 1 on both positions? Good question, no. So let's use cable. Let's just say, to keep things simple, you're opening up 0.5%, cable long at 122, okay? Let's say it equates to 2 lots. So you open up one lot. Of course, your first position is going to go to a 2 to 1. We'll go all over this in technicals now. Your first position is going for a 2 to 1. You secure that, okay? So you have one lot left open long, okay? You initially opened up 2 lots. Your first position, one lot at 0.25% is closed off 0.5%. So we're all on the same table here. You have one position that's running now, leave it run. Price rallies hard into 127 cable. You now want to be short. To lock that in, to become neutral on this position, you would open up one lot short because you have left running one lot long, and now you're going to open up one lot short, okay? This is the neutral, delta neutral approach. You're locking in, buying time until you average and net out a bias if you want to be long or short. But I want to reiterate, it's very rare you're going to do this. This is me explaining the harder side of it. The positive, the other side of hedging is simple, okay? Any questions on this so far before we go into it? I do something similar with a risk allowance on each side of the market, changing per major data release. Yes, SQ, very good comment here. So I agree with, for example, say you're net long, we'll go AU, you're net long AU, right? But you see potentially China's data turning horrific, or really big data point coming out. You think the Fed are actually going to shift into a hawkish tone and so on and so forth, hypothetically. But AU is rallying into an area of supply pre all of these data releases, okay? So you're thinking, hold on, I might see the dollar pick up steam here. Hedging pre-data releases and hedging pre sort of narrative shift potentially, if there's something that could come and disrupt the narrative. That's wise. That's portfolio management 101. You're basically saying, do you know what? Instinctively and intuitively and logically, I am net long AU, but X, Y, and Z is coming my way in the next 48, 72 hours, and we are rallying hard into an area of supply. So I now, as the portfolio manager, have to make a judgment call here to lock in the position neutrally, or you can go, if you're long, you'd be hedged delta positively, which we'll get onto. Will your stop losses differ on the hedge, or will it be the same as the original position? Your stop losses, Ayob, is it could be 50 pips, it could be 183 pips. All that matters is you're risking the same sort of risk allowance. Do you know what I mean? So, for example, I use cable just because the lots are easy to understand. Let's just say with a 30 pip stop loss, you had one lot open at 122, right? Then let's just say rallies up, you also have, hypothetically, this wouldn't happen in a real market, but you'd also have a 30 pip stop, so therefore you're going to be one lot short. It may equate to, let's just say in this example, AU, you've got 40 pip stop, so you open up 0.8 lots, right? And then when you're short, you've got a 12 pip stop, which only Julian probably in here does this with 12 pip stops. But then you may open up a bigger lot size. It equates to the amount of actual risk you put into the market. Does that make sense? Yeah, perfect. It's just, as we already know, subject to your stop loss and how much exposure you're willing to take on will then basically alter that lottage. You're essentially placing the same percentage risk, but the lot size may differ based on the stop. Correct. Now, guys, girls, this is the neutral approach. Very, very rarely I'll delta neutrally take something. It's again when I am at my peak of uncertainty, and price could go either way. A good example would have been recently, say you were interacting with UJ, dollar yen or pound yen or euro yen, where we had, if we go back to October or even a bit earlier, we had central banks raising rates and the forward guidance was relatively hawkish. But then we had the pickup in the Bank of Japan narrative, and we had some comments from the Bank of Japan, some remarks. So you're aware that if the risk on narrative continues, or if rates keep moving higher from the pound, eurozone, whatever it may be, it would make sense for the carry trade and the yield differential widening and so on and so forth, the interest rate differential widening, to carry those trades higher. But likewise, how sensitive this narrative is to the rhetoric of the Bank of Japan and so on and so forth. So you understand both sides of this market. So taking a delta neutral approach here, I would say wise, Whereas if you were taking a delta neutral approach with CAD yen post-COVID, Bank Canada saying, yeah, we're going to keep hiking, and Bank of Japan is saying, we're not moving rates. Oil is rallying, and you're telling me you want to delta neutrally position yourself here. I'd say absolutely why? Why? Why do you feel that's necessary? Does that make sense using those two case studies and being able to say one makes sense as to why you're neutrally approaching that market, whereas the other one is like, no, you should just be absolutely net long. So, the reason hedging is a topic that I personally think once you're in motion and you're trading well and you're seeing those profitable months and you're really starting to be in tune with the markets, that's the sort of next step, because it's not as simple as, oh, well, I'll just open up, the opposing side of the market. I'll just open up the same risk as I am long at every area of supply, every area of demand. Absolutely not. It's a combination of things. It's having the skill to identify where orders came in to the opposing side of your market. In other words, as we're going to look at in GA now, if you're short GA, you have to basically respect where potentially either profits were taken or where buyers stepped in to push price up. That's one thing. You've also got to be able to have the skill set to say, well, data's coming out on this day, or this is happening that could drive price to X, Y, and Z levels. So hedging is also respective to A, the data that's coming out, and B, the sort of timing element is very, very important, because sometimes hedging is absolutely not necessary, and you don't need to. If you're net short or you're net long a position and you think that the data coming out is going to continuously push that position, let's just say, for argument's sake, let's give a good example now. Let's just say gold. For example, you think the upside on gold is going to continue throughout the year. Absolutely fine. No problem. We're into Q1 anyway. And you are convinced. You are net long. You can be more long if you tried, right? Then in a situation like that, and you see gold pulling back, right? Just before an interest rate decision out of the Fed, just before Powell speaks, the likelihood is the market is trying to catch short-sided traders pre a big leg higher. There's a time and a place for hedging, and this is why it's a very, very important tool. You have to identify the opposing side of the market. B, you have to time it well with the data that's coming out, or a reason as to why you should be hedging, and then C, it's about managing that. So before I jump into the chart, Any thoughts, any questions on that? I think Julian put a message in about who's going to... Julian, did you say you're going to say something? Or have I misread something here?
Yeah, no. I wanted to say something when it is going to come to you, how to find your entries for edging, but we're not into you haven't spoken about that yet, I think.
No worries. Go on. Any thoughts from anybody else before we jump into technicals? Very quiet room here, guys and girls. Just, I want this to be very interactive. Great. Tumbleweed. Any questions? Or, okay, at least you can all do this for me then. You can type into the message, into the chat box. If we're understanding, yes. If we're not, say no. And if you don't, please tell me why. So if I'm net long but want to hedge, I'll look for a technical sell signal. We're going to look at the opposing side of that now. Derek, we're actually going to be net short. And then what we're going to do is look for a technical buy signal, if you like. So we'll jump into that now. Let me just pull this chart up.
True, there's one thing I was going to ask.
Of course, Katie.
I don't know whether you want to maybe cover it today, or it kind of is to do with psychology, but
yeah,
I don't know. I just think that maybe something to do with how like psychology impacts your ability to hedge, because obviously it can be quite a minefield, especially if you're new to it. So I don't really know exactly what my question is, but kind of how to approach the psychology of hedging as well.
No, that's a really, really good point. And what I will say is this, ironically, and I'll be transparent as day here, ironically, I'm probably not the wrong person, but I probably come from a different angle to 99% of people in this market because of how I view risk. In other words, I prefer when I'm in a hedge than I do when I'm in a net position, which is strange, right? Because most people would say, well, Drew, you're only hedging due to uncertainty, which should present some form of stress or whatnot. But to me, when I'm exposed to both sides of the market, I'm like, game on, game on, because whichever way this is going to flow depends if I'm neutral or not, if I'm delta positive, delta negative, whatever it may be. Whichever way this market is going to flow, it's going to be for a reason. In other words, let's say I'm hedged GA because let's say I'm net short GA, right? And then I hedge it because I think the BOE might come out really hawkish, the RBA are going to underdeliver, and I see a big tick up in inflation in the US. I think the Fed are going to hike again. So in other words, because of the sensitivity of the Australian dollar, I see potentially GA may react up from this, or the Aussie may weaken off, right? Then let's just say it happens. I'm actually net short, but price rallies up high and hard, right? I now know why that's happened, why that's occurred, and I can look for that pullback to leverage further. And likewise, if it doesn't occur and price actually melts, I'll just get back in on that, or I'll add another position on that pullback to the area of supply respectfully on the next area. To me, psychologically, I'm more at ease when I'm in a hedge, especially once they've de-risked. As Julian said earlier, I think you made a very good point, actually, that once you have a de-risked on your initial position, your initial bias, and your hedge is then going to de-risk as well, you're sort of like either way. It's very hard to go wrong here. So psychologically, I can understand maybe the angle you're coming from is more so, does it feel like you're cheating on your bias in a way? Is that the sort of psychological trip you're on about? Or is it more so you don't like adding additional risk onto the table but you would have de-risked by that point anyway? So yeah, from what psychological stance do you think, Katie, that is the biggest hindrance?
Probably more like managing the position. So like if you've hedged short and then obviously, I don't know, yeah, maybe managing the position and then adding, further positions into it.
Yeah, sorry, I've just seen Julian. Can I add? Julian, yeah, chuck in. And Ellie, I agree with you, yeah. Definitely stress reliever. Go on, Julian. Sorry, buddy.
Yeah, so I do think that the major problem that most traders have with edging is probably because we've been told how many times trade with the trend. And now we add fundamentals into it. So now we know where it's going to go in the future, right? So we're like, I shouldn't trade against the trend. And I do think that's something that, so sometimes we got stuff in our brain unconsciously, and that we've been told this so many times by books in tradings and whatnot, that it gets harder when we try to edge our position. But the cool thing is you limit your risk when you edge, because whatever happens, you either make more money, lose nothing, or like it's one of the best way, I think, to protect yourself, your capital, when you're trading. Also for prop firms is super good, because think about it, right? We have an equity limit. So if your buy if you're net short and then your buy comes up and you're delta neutral, for example, your equity is not going to move. So this way, you haven't lost anything. So, yeah.
No, I'm completely in agreement with you. I'm just checking now the GA. I'm completely in agreement with you. But the thing is, Julian, it's about actually transitioning that mindset, isn't it? And that's definitely something we can cover in psychology. What I will say, Katie, is once you have and this is my best tip I can give here. Once you have the sort of 3-month outlook in your head, the 6-month outlook, for example, like I genuinely can, I'm on record saying this, so hopefully we can clip this and throw it on Insta in about 3 months or so, but I can genuinely see GA at say 180 to 182. Like it makes sense to me, especially with a weaker dollar and that sensitivity, the beta sensitivity of the Aussie. And how weak I think, or how overpriced this bloody pound is, which you all are so tired of me screaming.
Just for the record, we're actually the 19th of December, 2023.
Yeah, we are the 19th of December, 2023. So for me, because I have that, well, you could say that certainty, it's never certain, is it? But because I have that confidence in my bias to the downside, to me, I understand that even if I'm hypothetically neutrally hedging the market, I know it's likely going to be temporary until things settle and I have another reason to add an additional short in. But because of let's just say something happens or some sort of risk event or some reason that you may think GA may rally hard from here, you're just doing what you have to do to protect that capital. But in the back of your brain, you're thinking 3, 6, 9 months from now, I see X, Y, and Z. So I know I'll likely net out sell side of this market, but I have to do what I have to do to manage a position now. Does that make sense with regards to the sort of psychology surrounding it? I thought I'm doing it wrong when I'm in both sides, same risk, but good to know. No, you're not doing it wrong at all. It's just a very, let's just say, frowned upon strategy that the reason it's frowned upon is people misuse it. For example, we're going to jump into a chart now, I promise. But for example, if you have, again, I'm just going to use it so everybody's on the same page. It's very easy to understand. If you're one lot short, one lot long, okay, but you want to be net short. And then sell side takes buy side out of the market, your hedge gets taken out, you skim some profits off, cool. You now know because sellers took buyers out of the market, it is a seller's market, point blank, If buyers were there, excuse the French here, but for those of you that know me, I use this saying a lot. If buyers were there, drawdown's a devil, break-even's a bitch, they would have pushed price away from that. And that's what, as Katie mentioned earlier, the cycle levels, we're going to look at them now, but if buyers were still present in this market, they would step in and protect those positions. So by sell side taking buy side out, you then have almost the green light for sell side to continue on pullbacks. It's likely going to be profits taken, price pulls back, add more shorts in. I don't understand Canadian French, Julian, in the Discord, in the chat, sorry. Yeah, I agree with you, SQ. I agree with you. So let's jump in to a chart now. Everyone can see my GA here. Just chuck it in the chat box if you can. Where's the chat box going? Here, there we go. Everyone can see GA? Yes, perfect. Now, let's have a look. So, 6 hour was the example I was going to use. There we go. Where are Rabobank targeting again? Oh, yeah, 146, 148. See, I could be saying Rabobank and saying 150, which is ludicrous. But we'll see. Now, okay, so let's go I'm going to go from here. Okay, bang. Talk to me. I want this to be as interactive as possible. We'll start on the daily, work our way from here. Talk to me. What are we all seeing here? You can type it up. You can unmute. I don't mind. I'm not the Zoom police. Just interaction is what I'm after.
Yes.
Julian, you're back. Talk to me. What do you see?
What do I see right now? I see a nice buy position near 1.89750.
1.89750 here, yeah?
Yeah.
Okay, apart from that, break down this price action for me in here. What's happened here? What's happened here?
So,
what's happened here again? And then why are we where we are?
Okay, so price respect both highs and lows, twice.
Okay,
so this tells me that they're pretty much unsure about where it's going. Either fundamentals are unsure or both sides of the market are entering. So this is like clearly where you can see that people are literally entering edges. Like
yeah. In other words, we're range bound here, yeah? That's fine.
Yeah,
I agree with you there.
Yeah.
Now, this is what we call sort of cheap Aussie, or in other words, expensive
cheap,
pound Aussie. And this would be expensive Aussie or cheap GA, in other words, if you're looking at it from a price action point of view. Derek has said, I see bulls struggling to push upside. Agreed, but you could also argue I see bears struggling to push downside as well. But what I will say is this. Julian is right. That's ultimately your market low and your market high. But what I see here is 193.25 filled. It left an area of supply. And then, of course, we've seen this move down and we've ended up breaking some structure. In other words, we've taken lows out. Now, I don't look at price action the same as other people when they say, oh, structure break and so on and so forth. No, all this means to me is the sellers that stepped in here, okay, have taken any buyers out that were in here, any buyers out that were in here, any buyers in this region. Otherwise, if the buyers were still here, they would step in. They would protect their position, point blank. Okay. Now, upon price being pushed down here, okay, you could have been net short, whatever it may be. There could have been multiple opportunities for you to hedge in here. Okay. So why, you're thinking, hold on, Drew, I'm just looking at the 12-hour here. We'll use this 12-hour chart. You could say, Drew, I've got this area here. I've got this area here. I've got this area here. Okay. Where am I hedging? Okay. Now, first thing I want to go over is this. I like to use a fib. You guys know this. But I'm not buying any region really of value unless I'm getting a good price on it to begin with. I don't really want to be hedging. And this is the important bit here. This is where we have to start taking that, not obscure, but taking that next step into the professionalism angle of things, okay? I don't want to be hedging unless I have to, or unless I'm getting a good price. So what do I mean by that? If there is no data coming out, right? If there's no reason for GA to potentially rally up and I want to be net short, I'm not looking to be a buyer in here. I'm not looking to be a buyer in here at all. Because I'm expecting, okay, I'm expecting buy side to be taken out because I'm net short. My bias is net short. But upon taking some real big structure out of the market, okay, we can only now assume profits will be taken. Now, for those of you that don't know, if you go and look at a market, there's a reason that once a high is broken, we tend to get a pullback. Once a low is broken, we tend to get a pullback, so on and so forth. Once that high is broken, we get a pullback. Once these lows are broken, we start to move, so on and so forth. The reason being is once a trade, okay, so for example, if I just do, I'm not going to replay it, but if you just go, I'll put a divider in here. If you look to the left here, right, last time price was as high as, say, 191,250, give or take, okay, was in, if you look to the bottom of my screen, was about February 2022, okay. Fast forward to June of 2023. Once market takes a high out, okay, it's unsure, it's uncertain. The market doesn't know. It says, well, hold on a sec. Is this a value? Will the market deem this expensive? Is this still, has this all been priced in now? Has the upside been priced in, so on and so forth? So when you see highs and lows broken, there's a reason people target them. Yes, there's an abundance of liquidity, but also the market is unsure of where it next wants to step because it's in unknown territory. Price has not traded here for a while. So why is that important when I discuss hedging? Well, when you start to break lows, okay, and we know buyers are no longer present, we then have to start thinking, hold on a sec. Well, how much can this drop before buyers step in again? We've dropped, again, this is why I like the fib. We've dropped more than fair value here, okay? So will buyers deem this as a potential bargain? And let's suppose at this point of view, you're getting some data come out, whatever it may be, and there's a reason you may see reversals coming into the market. You can then start saying, well, we've broken lows, so I expect liquidity to be taken here. And we have X, Y, and Z data coming out. So you may look to hedge this, okay? Now, coming on to the hedging aspect of it, price action. We know, in my head, I'm looking at this, I'm saying, right, sellers have stepped in roughly 193,250. If I want to get short this, I'm looking at the 193 handle to the 192,750. So that's where I'm looking for a pullback. Simultaneously, where buyers stepped in, if we go to the daily, again, higher time frames do dominate. We would have had that daily in there, would have been nice on two, but I'll show you how we manage this now. I would have said, well, where buyers stepped in, causing a big move to the upside, and that was respected, and we had another move to the upside. If there is going to be any area that may appetize a buyer, especially pre-news, especially pre-data, so on and so forth, to me, you're getting below fair value. So you're getting, if anything, a bargain. And on top of this, we know buyers deem this of value in the past. Now, where they started stepping into the market looks to me about that 190 handle. So due to that 190 handle being respected before, I'm now looking at the 192.50 to the 190.5, which, to be fair, the 192.50 was our play. Now, two ways you manage this, two ways you enter this market. And again, I want to reiterate, unless I have a reason to hedge this, then I'm not going to, okay? And what I mean by that is I have to be Of the belief that some sort of data is going to come out. For example, this is how I viewed this week, by the way. No, actually, was this the 13th? No, okay. I've got another example I want to use with the data that we've had recently. But the way I would have walked into this is thinking, well, do we have any data coming out that could basically, here's a good example. Let's say the inflation in the UK is forecasted to come out and it's going to ease, okay, which will basically drop the short-ended yields in the UK, drop rates expectation, drop growth expectation, everything, right? And we expect the pound to weaken, okay? This is stereotypical trademark, right? Of you see, say the data's coming out on, what's the date here? The 24th, yeah, 24th. No surprise, you start to see the market sell off the pound, okay? Buy up the Australian dollar 2-3 days pre-news, and then buy the rumor, sell the fact, right? As the news comes out, bang, of course, we start taking profits, pull price up to suck the wrong side of the market in to then get net short once again, okay? But now, ultimately, in a situation like that, I wouldn't be hedging this. I'd be saying, right, it makes sense that the market rallied, or sorry, the Aussie rallied against the pound into the data print. It makes sense the profits got skimmed once we broke a low. And I can understand that sell side of the market were anxious that buyers may still be present. So they're going to skim from here, okay? But with the remaining understanding that this shouldn't break where sellers stepped in the past. There's no reason for buyers to take sellers out of this market. Whereas if we put another narrative in there and let's just say this was pre-BOE interest rate decision and we expect the BOE to do either 25 basis points or do 50 basis points, we don't know. And let's just say hypothetically, RBA are forecasted to hold rates, right? Yet we're seeing GA drop into pre-BOE news, right? Now, or BOE rates decision. Now, you may be short this pair going into that decision because you actually think the Australian dollar's a better economy. But my lord, it makes sense for you to actually hedge that pre-decision because if they do come out with a 50, you're going to see that, you know, because of the rates differentials. Do we see how narrative, timing of price action and where price is trading into, i.e. taking out structure, trading into areas of value in the past that's not been touched, so on and so forth. Do we see how all of this ties in? It's not as simple as, oh, let me just buy at this hedge level. Let me just buy at this hedge level, so on and so forth. It has to tie into what's going on at the time, the narrative, the data, where value is previously confirmed to us, where buyers previously stepped in, so on and so forth. Am I making this make sense to you guys and girls, or do you need me to simplify it further? Chat box is there. I doubt we'll get any unmutes.
That makes sense. Makes sense.
Drew, was another thing I was thinking is, you know how obviously the data for the pound, like short term, has been printing better, like the PMIs on Friday.
I do, yeah.
That would be another reason why you would kind of think, okay, I'm going to hedge the pound more so than other currencies.
Yeah, and I mean, look, especially let's say you're a short pound Swissy, for example. That's another, yeah. And the market may start to react and start to buy into the narrative of the BOE holding rates higher for longer than the Fed and the ECB. So let's just say here, GBO2Y, 2 journal, I'll get back to the question now. GBO2Y. So let's just say, right, we've seen a big sell-off in yields recently. We've seen it in global yields, but you're expecting the PMIs to come out, right? And you wouldn't be surprised if the market starts to say, do you know what? We're buying into the fact that the BOE may actually hold rates higher for longer than the ECB, than the Fed. And you expect yields to potentially stabilize from here and potentially push back up into the 4.5 region, right? While simultaneously you expect other economies' data to become sluggish and start to drop off. If you're preempting a yield differential, short-end yield differential in favor of the pound in the short term, and you see data supporting yields moving higher, you see data supporting the BOEs, and yet you see pounds melted into those PMI prints, then hedging that, of course, that makes sense. Yeah, it's very subjective to how you deem the data to print and how you think it will affect the perception of the pound or whoever you're looking to trade. B, the short-ended yields, and C, just, you know, who's the dog with the least fleas and the dog with the most fleas, you know? So you only look to enter the hedge if your original position is at risk of being taken out completely. No, not necessarily. Not necessarily. So as I said earlier, with regards to, sorry, John, I know you joined halfway through, to be fair. I did mention it earlier on. I mentioned it again. It's all good. I mentioned how there's sort of predominantly 3 ways, but 2 of them basically mean the same thing, just different sides of the market. But delta negative, positive, or neutral. If you're neutrally hedged, right? For example, say I'm short 193, 250 up here. and then I get long at 192.50 here. Okay, I could have, say, one lot open here and one lot short, one lot long. I'm neutrally hedged now. Reason being is I can give a valid reason for both sides of this market to really catapult higher or lower. So in this instance, I'm going to lock in my P&L, and I'm going to essentially, the sort of, let's just say, off the cuff way of explaining this, or off script way of explaining this is, I'm doing this to simply buy time. So my P&L will be locked in, and until I have a clean cut buyer, so you know, actually, I want to be net short, and then say price pulls back up as the 193, then I'm now delta negative. In other words, I'm more exposed downside than I am upside. Okay, so do you see how the neutral hedging aspect of things isn't because I'm expecting this sell side or this buy side to be taken out? It's because both have valid reasons to take off. So I'm buying time until I figure out how I want to basically position myself in this market. But if I'm certain that this market is going to roll over, I will still hedge this, but I'll be net short. In other words, say I'm one lot long here, I'm half a lot, one lot short here, I'm half a lot long here. Or in percentage formats, if I'm left with a 0.25% short here, I might open up 0.125 long. Or if I'm 0.5% short, I'm opening up 0.25 long. Does that make sense, Jordan? No problem at all. So, guys, girls, I just wanted to clarify before I go on here. Do we understand that, as Julian said, it's not just ping pong. It's not buy side, sell side. Where's the buyer stepped in? Where's the seller stepped in? So on and so forth. There's an art to it. And the art is essentially timing as to why the other side of the market may step in. Understanding that if you've got a data print coming out and prices rallied into the data, prices heavily sold off into the data print, even though the data print is likely going to be positive, it may be the market trying to reposition, take out some liquidity, and fill some orders ready for the next leg up, so on and so forth. If the market is looking to switch bias, or the other way, let's say it's going to be a horrific print for the pound, and there's some other data coming out that's going to be Aussie supportive, you're expecting GA to melt, yet it melted way faster, way more aggressively than you preemptively expected. And there's a reason that it's taken out these lows, traded off of the last known area of value to be skim profits. And basically, it's sell side of the market telling you we're anxious that buyers may step into this handle. We've had the move that we needed. Data's coming out that should support GA downside, but we're going to skim some profits off the table, knowing that if the data comes out as we expect it to, we'll trap the upside of the market, fill more positions, utilize their liquidity, and will sell side take. Does that make sense? I know I've spoken really fast there. In the chat box, you can unmute.
Yeah, it makes sense to me.
Perfect. We don't need any tumbleweed. I see a thumbs up.
Would you also say that you could, you know what you're saying about data, but also if you think a pair is kind of been like what I'm trying to say is, like, for example, now the dollar, some may say the dollar is overpriced to the downside. So you're not just using news, you're using your perception of value.
Correct. Absolutely correct. And you're essentially, what you're doing there is you're saying, you know, if you believe, say, 80% of the move is priced in, and you're starting to get to the area where, let's just say, not the masses will step in, but where the move has been and gone, and you're starting to see some profits starting to being taken off the table, and you can understand why you may get a relief rally of 200-300 pips. So you may just want to shelter yourself from that. Then absolutely, yeah, makes sense.
Yeah, could I just add to that as well?
Of course, SQ, chuck in, my man.
Obviously, I was eating before I would have gotten the mic.
No, you're all good, buddy. You're all good.
But yeah, like recently with like ECHF as well, sometimes I like to deploy a hedge, like Katie's saying, when I feel like price is overextended to a certain direction.
Yeah.
So like we had like all-time lows on ECHF and things like that. So like I like to deploy a hedge in hopes that, okay, the data might not come in great, but if the data bottoms out, that's also like,
do you know what?
Timing
just to chuck in on top of this, SQ, again, really appreciate your input here, because what you're saying is very valid. And you know what you're using here, which you'll laugh when I say, you're using something that everyone here at BMO uses, but 90% of the market doesn't use it. Can you take a guess what it is? So what you're using here, 90% of market participants don't use. Have a guess at SQ.
You got me a bit flabbergasted here. I can't
on,
really
I heard someone else who said
Logic.
Who said it?
What's your opinion? Go on, KT.
I just say like common sense or
exactly knowledge. Exactly that. Do you know what, SQ, you're using common sense? And do you know what common sense is? Common sense is saying, guys, we're at all-time lows, right? And I'm short anyway. I'm rolling over. I'm making money on my downside here. If I want to just expose myself little by little to the upside, because we've never been this cheap in history, it's not a dumb move. All it is you're still net short. You're not neutrally hedged here. You're not saying, hold on a minute, I think the market is bottoming out right now. All you're saying to your portfolio is, look, don't you think it's a bit wise that I just expose myself a slight bit to the upside every, say, 100 pips to the downside, every 50 pips to the downside? Or when I see, let's just say, when I see buyers step in and start to take sellers out, for example, if there was a big area of supply in here on, say, a daily, and you start to see some big price action up, and you've seen side levels filling all the way up, and you're like, right, if price pulls back into here or here, I may be net short up here, somewhere in here, but I'm going to start to maybe be, if I'm, say, 0.25% short, I'm going to start to open up a 0.1 here, you know, and if this gets taken out, I may look for a 0.1 here or 0.1 here. Either way, I can understand that this is absolute like doghouse bargains here. And if there is a turn in data for any given reason, or if there's any optimism brought the euro's way, this could easily see parity in the space of 2-3 weeks of price action.
Yeah, exactly.
Yeah, I'm in the same. I'm of the same understanding with you here. I can see why you're doing that. Nothing wrong with that at all. And again, it's the common sense aspect of this is huge. I'm actually glad you mentioned that with eSwissy. And it's the same coming back to GA, right? It's the same situation here with regards to where you would have hedged this in here. Because ultimately, with regards to data now, again, using the hypothetical situation we've thrown out here, if there was a potential turn in data coming out, or for either side of the coin here, you'd understand as to why the market may look to pivot here, take profits off here, buyers may step in, so on and so forth. But ultimately, what's interesting then is, okay, as price pull back up, we now know this was 99% probable that this was profit taking, not buy side stepping in. Okay, ask me this, or answer me this, sorry, guys, girls. Why is it 90% probable that this area in here was profit taking? More than anything, more than buyers pushing price and taking sellers out. Why is this majority profit taking to reposition than it is buy side stepping in?
Because
And it's to do with
Yeah.
this price that developed.
Yeah, removed the zone after the reaction.
Exactly. In other words, sellers took buyers out, right?
Yeah.
Sellers took buyers out. So in that instance, you know, we could understand once sellers have taken buyers out, ultimately that's your cue and that's your hint there that this was not a sort of buy side stepping in. I would go a step further here and say this was more of a level built there for a target. And then I'd just playing on the order flow side of things, not your cleanest. You could argue 500 handle. Where did orders come in here? Definitely at the 92 handle. And then upon that being taken out, we had a pullback. I think price pushed up from here. Yeah, we had a push up from here. So again, this is the next question I want to ask. Why do we think we had a push up from here now? And we ended up taking sell side out. I think Julia mentioned it earlier, right at the start.
Took all the liquidity.
Because they want to group their orders together.
That's the best answer you're going to give me, Katie. With regards to sell side, yeah, value. More importantly, Julia mentioned it earlier with higher time frame. I believe it was the daily, yeah. So Julia mentioned how we're range bound.
Yeah.
Back a sec. We're range bound, and he mentioned how. And to be fair, to give you a fundamental understanding of this throughout October, November, December, basically rhetoric from both RBA and GA were basically on par. And to me, I've been screaming it for a while, like, why is this pair range bound? And on top of this, it was that fundamental question mark with regards to the dollar, hasn't it? You know, and ultimately the market has been containing this pair, in my opinion, until we had a development of weaker data out of the UK and until the high beta of the Aussie kicked in. So if we just pull back up now, okay, now price pull back up. Why was I not surprised that price pulled back up? 193.250 was the initial sell side. 193 is where we filled again. Now, let's look again. Why do we think I had this area highlighted? This is actually, now we're starting to get into how I actually traded this, because this is my live positions. Now, why do we think I had this area highlighted here? If I do this, get rid of this, price develop now. It's hard when I will say this though, it's hard when you're back testing without the actual raw hard data in front of you, because with the data and the narrative and the theme and understanding how things are printing and everything, price action makes 50 billion times more sense. Now, talk to me why. I can actually go back. But before I do this, let me pull the calendar this side and I'll get the dates up. Why do we think this is the first area I was eyes on? And I'll give you a hint. If I do this, if I do that, and that. Why was that the first area I was on? Whilst I pull up the data, give me a sec.
Order flow.
Correct. What do we see on the order flow?
Got like multiple psych levels being respected, like prices pushing, pulling back, pushing, pulling back.
It's the first where order flow, the first POV that order flow respected when it comes to, but last one, let's say.
Give me a sec. I'm just putting the data up. Yeah, you are correct. You are correct. What was the date here? Okay, this is interesting. Going into this, by the way, see this rally here from Tuesday high down here. We had a miss in the US inflation here. Okay, we had a miss in the US inflation. We all understand that the high beta sensitivity. In other words, for those of you that are watching this back, I know it's a recording, or confused with regards to the sort of sensitivity, Aussie is a currency that truly benefits more than others from a weaker dollar because of the bullish pocket it's in. Within a weaker dollar, more trade being done, more commodities being purchased, and of course the pro-cyclical nature of China from there. So Aussie tends to be a real sensitive Sally to a weaker dollar. We saw price rally up into this region here. US inflation misses, big move to the downside. Okay. Then on the 15th, we had industrial production and retail sales in China. Industrial production was up, retail sales were up in China, yet GA pulled back. Give me your thought process, guys and girls, if you can, as to why price would have pulled back on strong data inside of China, and in essence a missing inflation in the US, which played into Aussie's hands. How come GA bounced back up? What's your thoughts?
Or was it something to do with yields at that time?
Good question. Let's have a look. 15th of November. No, yields was pushing to the downside UK.
What was it again? The retail sales in China were up, and then the industrial production was down.
Both up, sorry. Industrial production year-over-year up, retail sales up, fixed asset investment up. Fixed asset investments like this. And unemployment rate remained at 5% in China.
I would have thought just repositioning for a better.
I'm with you. I think anybody that was looking to capitalize on strong Chinese data to levy a stronger Aussie has missed the fact that the Aussie is more trading off of the US narrative side of things. And on top of that, the bargain was up there. That was your play up there for the downside. On top of that, I think the flourish of liquidity that would have entered the market on a strong print from China would have allowed sell side to take profit off to pull price up. From there, then, what we had was just shy, annoyingly, 5 pips. I'll take that, though. Just shy of the 192.5 handle. Where do we pull back up into? I think I remember covering this in BMO. This is shy, I know. Okay. There's another position that's just shy. Pull back up into 250 handle. Did we sell off out of here? Okay, we pushed. Then we left an area at 191.750. And at this point now, I'm seeing a miss in US data. I'm seeing stable Chinese data. At the same time, by the way, we had core inflation miss in the UK, inflation ease in the UK. That week, give me a sec, nothing else out of the UK. Retail sales miss out of the UK. We had, to be fair, unemployment rate in Aussie also ticked up by 0.1% that week. And that was on the 16th. So there we go. Unemployment rate ticked higher in Australia here. Okay. How many people were coming to buy GA at that point? So understanding the overall narrative here, what I'm trying to get at, I know I've probably confused a lot of you here and as to why this was my first point of interest. I'll come back to that and then we'll build the narrative from there. We had a miss in US inflation that supported Aussie to move lower. Now, upon that, we came into a scenario where we could have seen the Chinese data come out horrific. We could have seen a continuation of Australian data come out horrific, big miss in the employment side of the Australian market, so on and so forth, although the forecasting consensus was not indicating this. But to take a hedge in here, why I would have been eyes on this level in here is because of where previous order flow failed. Yeah, so we had the 189 in there. Here we had just shy of the 750, but I'll take that. There we had just shy or just below the half handle actually, but we bounced the half on the pullback. That would have been a brick your pants moment. If I was looking at this, I would have been looking at the 750 hand. So that would have been, I would have carried some drawdown here. I would have been in some drawdown thinking I'm going to get stopped, but we would have de-risked fast. So, and then ultimately, as the data print's coming out and we get the unemployment news coming from Australia and so on and so forth, the fact that we didn't get a big push up any further and the fact that the sell side of the market has been respected in red here, I'd be optimistic in stating that, you know what, this was likely profit taking, as Katie said, repositioning, pulling price back to essentially shortlist of downside from here. Now, once this level's broken and all of a sudden, all I can see now is we're making lower prints. What are we doing? In other words, we all know this, we are quote unquote downtrending and sellers are taking buys out of the market. Now, until I get another reason to have to hedge my position, okay, I'm not going to, because ultimately fundamentals are leaning to the downside on this. So yeah, that's the sort of play. Do we trade out of that? There we go. And then this has been what else happened? I remember something driving this to the upside end up annoying me. Yeah, I remember we broke the low here. There was a newsprint for that. Let's have a look. Go to deck. Let's have a quick look this month. Previous month.
Was it the autumn budget?
I think it was, but I just want to clarify. That was market close, wasn't it? Sunday, yeah, market open. So I believe this here, the 4th of December, was, let me have a look. So this was again. So ask yourself this, guys and girls. This date here, Monday the 4th, okay, I'm going to read the prints to you, okay? Australian company gross profits quarter over quarter. We had home loans, investment lending for homes. So those are the three things out of Australia. We had Germany balance of trade, Germany exports. Then we had Swissy inflation. We had ECB speaking, factory orders from the US. Then we had some service PMIs from Australia. Company gross profits missed, but nowhere near as much as expected. Home loans were up aggressively. Investment lending for homes was up aggressively, and PMIs slipped slightly. Okay, that does not justify a rally of 200 pips. But you know what does justify it? The following day, we had jolts and we had some PMIs out of the US, and all the data that came out absolutely missed. Okay, and that was one of the turning points, again, aiding the weaker dollar. And it doesn't surprise me to see now orders starting to fill, and then we start to take some downside out, fill, an aggressive move. So the fact that we had moves like this coming in pre-print, okay, the point I'm making all of this, by the way, I know we're going off topic on hedging slightly, but it's not for you to think, oh, my bias is wrong or downside is wrong and so on and so forth. There is an art and a skill within identifying movements pre and post data and what they're trying to do, what they represent, where they're pushing into, why they're pushing into there. Are they trying to generate some liquidity to then continue to move to the downside, so on and so forth? Okay. Now, jumping back to the hedging side of things, have I lost everybody? I've just realized I've gone on an absolute ramble for about 40 minutes straight.
No, it's all good.
Okay, perfect. Okay, perfect. I will go into the next thing that I want to discuss now. Falling to yields during those days prior to the 6th, justifying the rally up. Yeah, could have seen a slight, but I believe we saw a pull in all 2-year yields there. But if you could check that for me, actually, that'd be interesting. I believe we saw globally due to the US yields falling. Fahim, what was the message you were sending Ellie? Type it into, if you click to everyone instead of just to Ellie, that will help. Or just to me.
That's I was driving whilst I was
You were driving.
doing this chat. I didn't realize it's only going to Ellie. When you were saying stuff like, what can you see here? I was writing like order gathering. I was like, and you were saying, I literally just wrote that.
No, you're all good. You're all good. Okay. Any questions before I move on? Because EA is oh no, we can use GA actually. I missed the hedge. And we can discuss this right now with regards to my actual live management of this. And it's bad management for me, actually. We'll jump into it. Any questions, or do we all understand? Oh, I need to keep that.
I guess like what you're trying to say is price still needs like a reason to pull back as well.
Yeah, yeah, exactly that. And ultimately, so I'll highlight it in, let's do green and no, let's go purple. No, not that. Purple here. And then let's go blue here. Ultimately, this is your cheap Aussie and this is your expensive Aussie. Okay. So when looking at this up here, you know that you want to be short this market for obvious reasons. Guys and girls, you know I've been screaming GA for a while now. I'm not going to go into the reasons why we're short this. We should all know this by now. But we can't argue with the fact that down here there was A, worry from sell side that this is now cheap GA, or B, buyers deem value, right? Once this level is taken, we know that the buyers are no longer at this level and there is no interest at this level, okay? But once we break this level, we also know that we are now going into unknown territory that we've not seen since June, and a lot's changed since June, okay? So looking at this, with the cells that we have inputted in, we're short from up top, 193, we're short from sort of, I'm short from 192 handle, so on and so forth, right? I mismanaged this position from the hedging side of it. Now, why was I looking to hedge this? Now, 13th of December, let me just pull the data up. 13th of December, okay? We were going into this, nothing really crazy. What I'm saying is nothing that was going to move the needle too much from the pound side. But what we did have was retail sales on the 15th for China, industrial production on the 15th from China. We had fixed investment and unemployment. Okay, so all of this, again, it's the next month on now. This isn't November, this is December's one. And ultimately, I'm thinking, right, well, if we get a big miss in that data print, it may justify some profit taken. And again, put in common sense into this. This is the 14th going on into the 15th of December. We've just seen a drop from the 192, 191.5 handle all the way to the 188 handle. Wouldn't it make sense for desks to close their books, declare their profits pre Baileys and on ice with the office on a Friday, and then a cheese board next week with their family at home? It makes sense to close off your positions. You see what I'm getting at here with regards to the what SQ mentioned earlier, the common sense angle of things. You've just seen a 300 pip drop. People want their Baileys on ice and their cheese boards. They want to book their profits, get their commission. They want to buy their kids some Toys R Us nonsense. So, of course, to me, seeing this move to the downside, seeing a double bottom broke, the amount of people that would have been buying as this approach down here, liquidity down here, there was a huge transfer of orders that were going to occur at this handle. You were going to see sell side take profit off the table and buy side's liquidity and stop losses utilizing and favoring this. In other words, the move you're getting here, this pullback, was not because of people stepping in and buying pound. It was because people booking and closing GA downside sells, pulling it back up. Because if you close a sell position, your broker's buying it back off you. Okay, it's just buying it back off you at a worse price that the broker gave it to you at. So the broker makes a loss, you make the money. But we can go into the market making side of it in another session. Now, the reason I was looking at this is because the date side of things is common sense, okay, going into the year end. And B, on that 15th of December, okay, which was the following day from this price action, we had all that data coming out for China that was forecasted to be relatively stable, to be fair. But we all know the uncertainty surrounding China. Now, on top of that, we had PMIs flashing from the UK. You know, there were so many things that could have thrown a spanner in the works here. I was looking at it saying, well, value is ultimately determined down here in the past for buy side. We know where the value for sell side is. If there's going to be anyone stepping in to buy this based off a speculative position, based off data that could print the other way, for any given reason, where was the value that we know to be true? Well, it's here. Okay. Now, on top of that, the handle that we had, 188. And you know what? Excuse the French, piss poor management from me. And I'm being transparent here because why aren't we? As traders, we should always be transparent of our mistakes. Is how we learn. Now, the beauty of this is, if I was long and hedging it from in here, I personally would have been targeting this area of supply, this 91, to get short again. Okay, I know my charts are a bit messy here. Let me do this, and not this. I would have been targeting this 91 region, buying out of this daily here. So buying here at the 88 handle, and I would have been looking for 191 shorts. Now, if you actually delve a bit deeper, what we pulled into, I can't do it without the, what we pulled into was, to be honest, an area of value. But more importantly, if I do this, we pulled into the 190.5. Am I angry that it didn't pull back up to the 191? No, because I'm not hedged long to add. I would have been, by the way, how I would have managed this, to give you an example, I would have been delta negative on the stance that I'm more exposed to downside than I am the upside. Okay, so I'm looking for downside on this. So I wouldn't have opened up a neutral position here because I think GA has more legs downside than it does upside. This is an example of not taking a neutral approach. And all I would have done is then, as price pulls back up, I would have entered a short into that 191 handle and then looked to this buy side to be taken out. I want that going. I want it gone. That's the cost of doing business. Ultimately, I will net out more of a positive position. Now, Mark likes to move his stops to break once he approaches his short. I can understand that. That makes sense to me. I tend to leave it exposed because, to me, if buy side have stepped in once again in here, usually what you tend to see is as prices come back down to the region, we tend to have data, so on and so forth. I just view it as the cost of doing business. I pay the fee because this position will pay me back tenfold anyway compared to what that's costing me. The way I view it is literally like an insurance policy. Because it's happened to Mark a few times. If he was here, he'd admit it, where he's moved the stops to break, prices come down like that once more, and then something's happened and we've actually seen a steeper pullback. So I view it as the cost of doing business. Now, final point I'll make here, why did we see this 190.5 actually trade? Well, of course, the data came out really good on that Friday for China, early hours. 2 a.m. the data print came out, right? 2 a.m. was the data print here. This was the data print at one. Imagine that, GA at 190.5, and we get positive data out of China. Shock horror, right? But ultimately, markets came back down to where profits were skimmed, where you could argue buyers stepped in the past, so on and so forth. And because of this, then we're seeing people skim further profits. And of course, throw common sense onto this. It's Christmas. Nobody's going to chuck huge liquidity to the downside on this. And nobody's at a desk to even do it. You've got no brokers or no market makers filling it. So I expect now this to be range bound here going into the new year, or it wouldn't surprise me to see some slight going into first week of January, maybe second, so on and so forth. No, probably first. Second week of January. Wouldn't surprise me to see a slight uptick in this pre-data to snap some downside then. Again, repositioning, adding in. So jumping into the questions here, Simon, 191.50 first eyes on for shorts. So you were first eyes on shorts for here. 180 hedge, looking for pullbacks into the 191 for further sales. I'm probably being stupid when I'm reading this here, Simon. I want to dip into more hedging, but I don't have a crystal ball, so I was watching. Okay, so yeah, here, because the higher time from the daily side of things, okay, to answer that question, Simon, this was the move. If I do this was the move that caused this the downside. In other words, sellers stepped in at the 191.5 to cause the move into the 188. Okay, so yeah, 191.5. So due to this, the next reload of orders I would have presumed would have been a 91 handle. But we then have to be realistic with market pricing and the dynamics surrounding the market. What actually occurred was upon the profit taken on 188, this was pre-Chinese data, as we know on the Friday, and pre a bit of UK data. Price bounced, profits being skimmed, likely some hedges in there, but net short. Okay, this is where we know last buyers to be. And then because of how positive the data printed from China, we saw price melt out of the 190.5. So arguably this is where sellers stepped in again. Now, looking at it from a value point of view, we don't really have much we can work off except the 4-hour here. So my first point of interest, Simon, would now be 190 to get short again. And if this level doesn't hold, I can reason with why price can pull up to 191, and that will be my next point of interest. But it's very unlikely we see that 193, 250, 193, 192.5, 191, 750 handle broke. That's why it's a very probable short at the 191, but I'll speculatively short this out the 4-hour 190. Not, guys and girls, financial advice. Does that make sense to you, Simon, with regards to how I'm approaching sell side? And then ultimately, what I'd expect then is that sell side to take my buy side out, because this was just insurance based off what was going on at the time, data-wise, the aggression in the move going into that region pre-data, so on and so forth. Perfect. Sorry, guys, I got a bit of a cold. So would you close the buy? Don't know if I understood it right. No. So me and Mark have different approaches on this. I actually I view it as okay, how do I word this from like a day-to-day stance? It's like, well, it's car insurance. I'm paying that insurance, not because I want to crash the car, but ultimately I know at the end of the policy, if I want to sell my car, I'll recoup, maybe make some money on it if there's been a shortage in Mercedes or whatever, I don't know, right? Point being is, right, I'm happy to pay the insurance cost here. Similar with this, I'm net short, and ultimately the more the market moves down, the more money I'm going to make. But I'm going to pay a bit of money along the way to ensure and protect the position if things go peak tong and go wrong, and absolutely we get a rally to the upside. Okay. Now, the reason I don't move my positions to break even when I'm hedged is because if I enter a hedge in here long, okay, and again, if Mark was here, he would say, yes, this has happened to him a few times, right? And then we see this move, which we did, a big leg to the upside, okay? The reason I'm doing this hedge and entering this hedge is because I'm looking for price to pull back up into the next area of value where I can get short, but it didn't do that. It traded off of the Chinese news, which is fine, and it sold off. But there's nothing stopping this, as it's doing right now, there's nothing stopping this filling again from here and moving higher once more. There's nothing stopping it doing that. Price may seek value, maybe not as aggressive as that, but price may want to seek value at that 191 handle, So for this reason, I do not move stops to break. The way I'm managing this is with additional positions rather than just stops to break and so on and so forth, right? I'm looking to add another short in here, and then I'll leave this exposed, And once this comes in and I get stung on this, which I'm going to pay the fee of trading, I'm going to pay the cost of doing business here. Ultimately, the positions that I've accumulated will pay me tenfold back anyway. So this is one thing that we all must understand when you're hedging, is you are going to be paying the cost of doing business in this market. It will likely net out lesser of a position if you were just net bias, in other words, just long or just short, but you'll be more consistent in your portfolio fluctuations. Does that make sense? You're paying the insurance fee to ultimately, well, average out a more certain position, less delta in your portfolio, more security and more management, if anything. Does that answer that, Derek, by the way? Sorry, I probably caught you off guard there, Derek. Yes, thanks. Just asking how to manage. Yeah. It's very hard, Eddie. So to give you an example, to run over it one more time, as I'm short at the one night, let me double check. It's 192.5, I believe it is. Yeah, 192.5. Short here, okay? And let's say we short again, 191.5, okay? I know I'm net short in GA point blank, okay? Now, when I open up the hedge, which I missed, by the way, GA, the hedge I missed. I've been transparent about that. Piss poor management. When I open up the hedge long, I'm not doing this with the intentions of GA doing this. I'm doing this because, as we discussed, the data that was coming out, the velocity of the move, pre-data, so on and so forth. But I'm doing this with intentions of, as price pulls up, I want to add in again short, okay? But if this decides to push up and up and up and up for no reason, sorry, 2 secs, decline that, for no apparent reason, or let's say data gets horrific, or let's just say there was a big miss in Chinese data, we saw huge PMIs out of the UK, and this wants to rally hard and the market wants to tick up UK yields or whatever it may be, at least I have some exposure to the upside, and these short positions would have de-risked anyway. So ultimately, I don't really care. But I'm only doing this out of security, okay? But ultimately, I want to be adding another position in. The reason I'm not moving this to break even is for the reason I just said. If this wants to come down, fill a few more times, and we want more value, the data turning, rhetoric miss, whatever it may be, I want to keep that there as exposure to the upside. The reason I'm hedging here, I'm not neutrally hedging, I'm still net short. I just have that slight exposure to the upside. And if this gets taken out, the short side that I have will pay me tenfold compared to what this is going to cost me. Therefore, it's just the cost of doing business in this market. Does that make sense, Ali? Perfect. So guys and girls, that's a sort of touch upon hedging. Hour and a half in, I was only planning on doing an hour, but just I could go on for hours and hours on it. This is the sort of touching point on it. What we will end up doing is focusing massively on delta neutral examples, then delta negative, where you've got downside, delta positive, where you've got the upside side of things. And what we can do from there is case studies. We can use live data that's fed into the price action that we've got. But one thing that I will always suggest when you're hedging is the following. Understand where buyers stepped in and where sellers stepped in. Understand your value, your fibs, your price action, everything. Understand where sellers are likely going to seek to push price, or where buyers are going to seek to push price, because A, areas of liquidity, and B, areas of value where it's uncertain price action, likely you're going to get skimming, so on and so forth. And then C, understand why price would move like that. Why is price moving 300 pips to the downside? Why is it rallying hard to the upside? And why would you skim profits pre the data that's coming out the following day or 2 days from now? It's all in conjunction with what's going on now, why price is moving as it is, what's going to be brought our way, and how will this affect the narrative too. And ultimately, for example, with that GA situation, right? The forecast and consensus was for positive Chinese prints. I'm just looking at it now. Everything was indicating that what was going to happen was actually going to be GA supportive to the downside. Although price pulled back up before that Chinese print, essentially it was just the market skimming profits. It came into a daily area of demand, unknown ground. Again, we've taken the area, the double bottom out, tons of liquidity presented. Sellers are happy with the money they've made, skim profits off pre closing the book for Q4. And on top of that, then price pulled back up, got better value on downside on the Chinese print. We sold that at 190.5. Are we starting to understand the sort of market movements and dynamics with where the sort of hedging can come into it? Perfect. Thumbs up from SQ there. Nice. Bellissimo. Yeah, appreciate it. A lot clearer. No problem, Eb. No problem. It's all about, like I said, it's all about understanding your markets and your moves and knowing where buyers last stepped in. For example, before I go, just to share my screen again. No problem, Simon. No worries. So if I just share my screen again, for example, like that move was aggressive. Whoever was buying in here was like Santa coming down the chimney with regards to value. It was like, wow, okay, we had a 2-day rally that drove price up 350 pips. If you're verbally looking at it or quantitatively stating it from a numerical stance, 187.75 into the 191 handle is not a cheap move. Like that's a move. Do you get what I mean? So if for some reason there was value deemed still to be at the level and sort of 187.5 to 187.750 was where the sort of action occurred in here, being sensible and skimming at the 188 handle is not a bad move, even though you're net short, or if you want to open up a slight hedge to the upside to cover yourself, because of everything we just discussed. But ultimately, you're only doing this to look to get net short again. You know, it's just the cost of doing business. So guys, girls, that's me on today's session. If you could chuck in, suggestions for tomorrow for me and Julian, that would be great. Julian and I did say about psychology at the start of this session. For those that have come in a bit later, so on and so forth. Psychology is a really good topic. We can speak about the primary, secondary psychology and how it links in. Because most people have a complete misconception of psychology in FX. Everybody says, have no fear of missing out. Be a robot. Be like Arnold Schwarzenegger in Terminator. Do you know what I mean? It's
Yeah, we're not Rambo.
What's that?
We're not Rambo.
Yeah, and yeah, you know, it's the binary opposite. Actually, it's about understanding. It's about the way I would summarize it is about increasing your emotional intelligence above all else. But yeah, that is me on today. A pleasure as always. I will get this sent over to Mr. Simon now. It will be on the website probably about half hour. If anybody wants to watch it back, so on and so forth. But yeah, pleasure as always. For now, it will be psychology until told otherwise with regards to tomorrow, or until suggested otherwise. Found that really useful. A lot of questions answered. No problem, John. No worries, Ellie. SQ, always a pleasure, mate. Fahim, take care. Drive safe. No worries, Katie. No worries at all. And yeah, same time tomorrow, guys and girls. It will be psychology unless updated otherwise. So yeah, that has been us at BMO, and we shall see you tomorrow. Take care.